everyone. Thank you so much for listening to another video out of our ratio series. Today we talk about profitability ratios. There are three other videos, one for activity ratios, one for liquidity ratios, and one for solvency ratios, and then basically you are covered. We also looked at some of the ratios when we discussed financial statements such as income statement, balance sheet, cash flow statement, because this is where you get the ratios and the data from. So sometimes you look at the topics. What would you like to analyze? Is it about the liquidity of a company, the solvency, or the profitability? Here I give you the overview of the key ratios. Sometimes if you do financial statements analysis and you go through the income statement, then it's good to know, okay, which kind of key ratios can I extract when looking at the income statement only. So let's get started. Profitability ratios. What are profitability ratios? First, profitability ratios measure the return earned by a company during a period. You will see most of the ratios, especially for the first part, return on sales ratios, it's mainly coming from the income statement. That's why we talk about the return, the profitability of a company during a period. And it is really important because revenue as a total number doesn't say much, but how much return, what is a percentage of, for example, gross profit over revenue, net income over revenue. If you compare this with other companies or over time, you basically get insights into the performance of the company. Let's get started. There are two key areas. One is based on return on sales and the other one is on return on investment. When we talk about sales here, it's basically the same as revenue. We usually say return on sales, return on equity, return on assets, but whether we call it sales or revenue, it doesn't really matter. When you look at those key ratios for return on sales, you basically only look at the income statement. That's why you have come across in some of the other videos when we are talking about activity ratios, we take data from income statement and balance sheet, and whenever we take data from the balance sheet, we need to average, because income statement covers a period of time, balance sheet covers data only for a point in time. Here, when we look at return on sales data, we don't have this problem because all the data is coming from the income statement. Those four are actually quite easy to understand because all of them can be derived directly from common state income statement. I've made another video on common size income statement, but here gross profit over revenue, what is a percentage? The higher, the more profitable. Operating profit margin is operating income, goes one step lower over revenue. Pre-tax margin, EBT, net profit margin, net income. So what is happening if I take a simplified income statement and I use EBIT and EBT? It starts with revenue, cost of goods sold, then we have gross profit, that's the number you see here, minus SG&A. Then you have your operating profit margin somewhere here, operating profit, and then you have other items such as D&A and interest and so on. Then you have your pre-tax income minus taxes, net income. It's not 100% correct how I use the items here, but just for illustration purposes, we actually go through step by step. So here the first one, gross profit margin, gross profit over revenue, then operating profit over revenue, then EBT over revenue, and then net income. So you can actually see at which state does the company loses money or has the biggest expense item, so to say. So that's what we are doing. You can see all those ratios directly from common size income statement. one thing, and this is why my income statement is not 100% clear and consistent. For example, here operating profit margin, you see here operating income over revenue. Many times you see EBIT over revenue. We use EBIT as a shortcut representation, but we know, strictly speaking, EBIT includes non-operating items such as dividends received and gains and losses on investment. So it's just important to be consistent when you compare companies, different companies, that you ensure you exclude or include the same items. Yeah. So just be mindful of that. If you use operating income with one company and EBIT with another, that you really understand what is part of those items. Yeah, and this basically, the higher the number, the more profitable. There's nothing really, if you have a high net income over revenue, the company makes a lot of money. The bottom line, as we call net income, is quite big compared to revenue, and so on. So here it's not much to actually interpret. Really a higher number here means on each item the company is performing a bit better. Then we have return on investment items. And here how I would look is, as discussed in some of the other videos, the denominator is all about what comes in. You use your total assets. What are they generating? What is your operating income? Gives you return on asset. You put assets in, you get a return out. Same here for this is operating return on assets. This is return on assets, ROA. You put your average total assets in, you get net income out. What is your return on your assets? Here again, we take average because these are balance sheet items. And then basically the same. I come to return on invested capital in a second. If we go to return on equity here, we say, okay, we are not looking from an asset perspective. We look at what our equity providers have inputted into the company and what is the net income. So how much net income has each dollar of total equity generated. And return on common equity is basically the same. What we do, we say, okay, the net income is actually not available for our common shareholders. So that's why we need to exclude our preferred dividends. And then what we look at what our common shareholder have provided in capital for us to generate net income minus preferred dividends. Yeah, so again, input and output, input denominator, output numerator. There are one formula a bit different, which is return on invested capital, ROIC, which is your EBIT 1 minus effective tax rate, also called NOPAT, net operating profit after tax, divided by average total short-term and long-term debt and equity, which is basically your total capital. Yeah, when we say capital in finance, we don't mean cash, something different. Capital means equity plus debt. It's your total capital that was invested. Yeah, that's why we call it return on invested capital. Our debt providers and our share provider, they have provided capital, and how much net operating profit after tax have we provided. There's another one, return on capital employed. Capital employed, invested capital is all the same. I think there are a few minor ones, but 99% of the time you can use them interchangeably. Some analysts say return on invested capital measures how well a company generates profit from both equity and debt capital, which makes sense. Return on capital employed is similar. Sometimes uses EBIT instead of NOPAT and focuses more on long-term capital employed. They sometimes use a different denominator invested capital versus capital employed. Depends. ROIC sometimes excludes cash and equivalents from invested capital. ROCE is more used in accounting, and return on invested capital we compare with weighted average cost of capital to look at value creating opportunities. But in general, especially if the company has no short-term debt, both measures are approximately the same. Yeah, so here again, return on investment, who is providing capital? Is it our equity holders? Is it both debt holders and capital and shareholders? And you would like to know what is the return of the capital provided? Or do you look at the asset side of your balance sheet and want to know how much return have our assets generated? Yeah, these are the 9 key ones. I hope you found this useful. I see you in another video. Thank you so much. Bye-bye.